Barry, it's interesting when you have governments get involved, whether it's fiscal or monetary policy, it's almost as though the governments choose the winners and the non-winners. And that's been a big issue. You've seen that just even throughout COVID in terms of who's allowed to stay open and who wasn't. We're also potentially going to see that within the financial system because of how they have gone about, to your point, raising interest rates. And you say they've done it the wrong way. It has been ineffective. So why don't we parse out in terms of the areas of the economy that will feel perhaps more significant pressure than others?
I've been describing the U.S. economic environment as an unstable equilibrium for some 6 months or so now, shortly after the Silicon Valley Bank collapse. And it became clear that the household sector has largely termed out their mortgage debt. A large percentage have fixed rate mortgages. So the effective mortgage rate is something like 3.86% or so. So our household sector is largely immunized from the rate hikes. The large non-financial corporate sector is similarly positioned. They termed out their investment grade credit debt, and so they're fairly protected. Small businesses, small banks, and the real estate sector have no such level of immunization against rate hikes. And so, the way small banks work is they take in cheap deposits and lend the money out longer term. They don't hedge their duration, like the Bank of America would or JP Morgan would. They really just count on being able to borrow short and lend long. And so with this deep curve inversion, that has cut off credit to the small business sector. That's the most opaque part of the economy. We get the least amount of data on it, but it's some 65% of total employment. So if you've looked at,
Wow.
we've looked at things like net revisions in the monthly payroll reports have been down 9 of the 10 months that have been reported. Undoubtedly, that implies that the models that estimate small business employment are overestimating business employment. Small businesses are struggling. Small banks are struggling. Banks are also not in a position to finance the government, which is why, we have these struggles in the bond market as well that were not made better by the machinations of the Treasury 3 weeks ago when they changed their issuance schedule. They did a little more than put a Band-Aid on a big problem.
So can you describe that aspect a little bit? Because I don't know that people are understanding what's really going on in the treasury market. And in addition to perhaps what changed 3 weeks ago, there's also more commentary, but I feel like we've been talking about this one forever, which is that there's going to be less and less demand for US treasuries, in part because the amount of debt that's being created, but also from a geopolitical perspective, that maybe there's less interest in the US dollar and US debt. They've been saying that for years. I don't know if it's true. It may be a bit difficult to back up, but what can you describe what happened in the treasury market and why we need to care about it?
Sure. Well, first of all, there's only really been two occasions in my 39 years in the business where I watched the bond market really back up, meaning rates move higher to absorb supply. The first one came on beginning on January 4th, 2021, when the Republicans lost the Senate, and we went from expecting no new stimulus to getting another 1.9 trillion. And we had a sharp move higher in 30-year TIPS yields, which is the part of the market least impacted by the Fed's balance sheet or rate policy. That began again in early August, and we had a similar order of magnitude move to absorb the extra 500 billion that the Treasury announced they were going to have to sell in the second half of the year to finance the growing debt and deficits in the US. So what the Treasury did specifically, though, to try and resolve this was announce that they were going to sell more than the recommended amount of Treasury bills. Well, that seems fine because there's lots of liquidity in the system, but that liquidity is drying up quickly. Banks are hoarding their reserves and their cash because of some of these financing issues that I've discussed. So it's actually tighter than the Fed thinks. And then they're selling more bonds in the so-called belly of the curve, 2s to 7 years. Now, remember, the bank's three biggest, or the Treasury's three biggest buyers were the Fed, who's now not buying. They're actually letting their portfolio run off. The banking system, who's not buying. In fact, small bank holdings of securities are falling at a 20% annualized rate. And then the third buyer you alluded to were foreigners, Asians in particular. And I don't think that's so much about geopolitics. I think that's about deglobalization and slowing global trade. they just don't have the surpluses anymore. So they don't have the demand for treasuries. Japan and China, that's particularly true of. So we have a real crack up coming here in the US. We've already seen 2 waves of it. And, they can tweak it around the edges, but there's a real supply and demand imbalance in US treasuries.
We'll take a quick break. We'll be right back.